If you're sitting on Bitcoin right now and you're underwater, this video gives you the exact 3-step plan that experienced holders use to decide what to do next. Not hopium, not a price prediction. 3 concrete steps in order, and I'm giving you all 3, starting now. Step 1 takes about 2 minutes and tells you whether what's happening right now is actually a threat to your thesis or just noise dressed up as a crisis. Step 2 shows you the one number almost nobody's talking about this week, the number that matters more than the red candle on your screen. And step 3 is the one almost nobody actually does. It's the step that quietly decides whether you make it through this drawdown with your position intact, or whether you become another story about someone who sold at the exact wrong moment. Stay to the end, because step 3 changes depending on one piece of information I'm going to give you in the middle of this video, and if you skip it, the plan doesn't work. Here's where we are right now in plain numbers, spelled out so there's no confusion. Bitcoin is trading around $63,600 to $64,700. Down again today, still sitting roughly 50% below its all-time high of $126,198 from October of last year. In just the last 24 hours, Bitcoin alone accounted for roughly $300 million of a $1,470 million liquidation wave across the crypto market, with short sellers actually taking the bigger hit this time. That's not a typo. More bears got liquidated than bulls in the most recent window, which already tells you something about how one-sided the everyone is panicking narrative actually is. There's one more number worth knowing before we start, because it's part of the same news cycle and most channels are burying it. While all of this has been happening, FTX began its 5th distribution round this week, sending roughly $900 million back to creditors from the 2022 collapse. That single fact is a useful reminder of how different this current drawdown actually is from the last one. And I'll come back to exactly why that matters when we get to step 3. If any of that made your stomach drop a little, good. That means this video is for you. Let's go step by step. Okay, before we continue, I have a quick question for you. Leave a comment and tell me the city you're watching from, what time it is there right now, and what the weather looks like outside your window. One of the best parts of creating engineered markets is realizing just how global this community has become. It's amazing to see people from every corner of the world watching the same video, often at completely different times of the day and under completely different skies. Thank you for being part of this incredible community. I read your comments every day, and seeing where you're all watching from is one of my favorite parts of this channel. So go ahead. What city are you in? What time is it? And what's the weather outside your window right now? Step 1. Diagnose. Is this actually thesis breaking or just noise? The single biggest mistake people make when they're sitting on losses is reacting to the price before answering one question. Has anything actually changed about why I bought this in the first place? That sounds obvious. It isn't, because when your account is red, your brain doesn't process information calmly. It processes it as a threat. And threats demand action, any action, right now. That's exactly the emotional state that turns a long-term holder into someone who sells at the bottom and buys back at the top 6 months later. So here's the actual diagnostic. Ask these 3 questions, in this order, before you touch anything. Question 1, did the protocol change? Not the price, not the headlines. The actual thing you own, a fixed supply, permissionless network that lets one person move value to another person anywhere on the planet without asking a bank, a broker, or a government for permission. That hasn't changed this week. It didn't change during the liquidation wave, it didn't change during the Fed meeting, and it isn't going to change because of a red candle. Question 2, is this leverage washing out, or is this real selling? This distinction matters enormously, and almost nobody explains it clearly. What we're seeing right now is a textbook thin leveraged market doing what thin leveraged markets do. Big players position around obvious liquidity levels, the price zones where the most leveraged bets are sitting, and push price into those zones, letting forced liquidations do the rest of the work. That's not a conspiracy, it's just market structure. Over the past few days alone, liquidations in Bitcoin and the broader crypto market have swung wildly. One 24-hour window saw roughly $280 million wiped out, split almost evenly between longs and shorts, while another saw $1,470 million liquidated crypto-wide, nearly 2/3 of it on the short side. When liquidations are running that hot in both directions inside the same week, what you're watching is mostly a leverage flush, not a verdict on Bitcoin's future. Question 3, is there a forced selling event actually happening? This is the one that would genuinely matter, and it's worth being specific about what one actually looks like, because we've seen it before. In 2022, over-leveraged lending platforms collapsed and FTX went down with them, dragging Bitcoin from around $69,000 all the way down to roughly $15,500. That was forced selling. Real entities going insolvent and being compelled to dump real coins regardless of price. There is no visible equivalent of that happening right now. No major exchange or lender has failed. No forced liquidation of institutional balance sheets is underway. What we have instead is elevated volatility around a Fed decision, geopolitical tension in the Middle East, and a leveraged derivatives market getting shaken out in both directions. Run those 3 questions, and as of today, here's the honest read. The protocol hasn't changed. The current move looks far more like a leverage washout than a structural collapse, and there's no visible forced selling event underway. That doesn't mean the price can't go lower. It very well might. It means the thesis you bought Bitcoin on almost certainly hasn't broken just because the chart is red this week. Here's the part I want you to sit with for a second, because it's the number almost nobody's making the connection to. This week's macro backdrop is genuinely unusual. The Middle East conflict has kept the Strait of Hormuz disrupted. Oil has ripped roughly 26% higher in July alone to around $90 a barrel. Gold is sitting near $4,090, and the 10-year Treasury yield is at 4.67%, with the 30-year above 5.2%, the highest level since 2007. That's a market broadly repricing risk everywhere, not a Bitcoin-specific problem, which raises an uncomfortable question. If oil, gold, and long bonds are all moving on the same macro fear, why is nearly every crypto YouTuber explaining Bitcoin's drop as if it's an isolated crypto story? Here's the honest, slightly uncomfortable answer. It's easier content to make. Bitcoin drops because scary war headline fits in a 15-second clip and needs no follow-up research. Bitcoin drops as part of a broader repricing of risk across oil, gold, and long-term bonds, while a separate and genuinely more important institutional story unfolds in Washington, doesn't fit in a clip. So almost nobody makes that video. You're about to get that video anyway. Before you move to step 2, do one more thing. Pull up your own entry price, or your average cost if you've bought over time, and write it down somewhere you'll actually look at again. A note on your phone, a sticky note, anything. Not because the number itself matters emotionally, but because in a minute, you're going to compare it against a completely different kind of number. One that has nothing to do with your personal cost basis, and everything to do with what large capital is actually doing right now. That contrast is the whole point of step 2. I'll come back to that. But before we get to step 2, quick note. I built something specifically for weeks like this one. It's called the Bitcoin Holder Mindset. And near the end of this video, I'm going to give you a discount code that takes it from $97 down to $47. I'm not going to pitch it yet. Let's finish the plan first, because the plan is what actually matters right now. Not everyone watching this is in the same position, and the rest of this plan lands differently depending on which one you are. So take 2 seconds and place yourself. Group 1 bought within the last several months, closer to the highs, and is now looking at a genuinely large unrealized loss on paper. If that's you, step 1 matters most for you right now, because the emotional pull to just get out and stop the bleeding is strongest exactly at this stage. And it's also the stage where selling locks in a loss that a longer time horizon might have recovered. Group 2 has been holding for a full cycle or more, has seen drawdowns like this before, and is mostly just tired of watching the number bounce around. If that's you, step 2 is where the real value is, because you've already survived the emotional part. What you're missing is usually the updated read on what institutional flows and the regulatory backdrop are actually doing right now, since that's the part that changes month to month. Group 3 hasn't bought yet, is watching this happen from the sidelines, and is trying to decide whether a drawdown like this is a reason to finally get in or a reason to stay away. If that's you, all 3 steps apply, but step 3 matters most, because the framework you build before you ever buy a single coin will do more for your outcome than the exact price you happen to buy at. Wherever you land, the plan doesn't change, only which part of it deserves your closest attention does. Let's keep going. Step 2, check the real signal. Institutional flows, not price swings. Here's the number almost nobody's talking about, and it matters a lot more than today's candle. US Spot. Bitcoin ETFs just closed out July as the worst month for net capital raised in the entire history of these funds, roughly $205 million net for the whole month. To put that in perspective, earlier in July, these same funds pulled in nearly $981 million across just 7 consecutive trading days. And in the final week of the month, they saw 4 straight sessions of redemptions totaling more than $526 million. That's a dramatic reversal in a very short window, and it's a far more meaningful data point than any single day's price move, because it tells you something about positioning, not just sentiment. Now, here's why that number is more useful than the price chart and why I asked you to hold on to it. A price candle tells you what happened. Institutional flow data tells you what large, sophisticated players are actually doing with real capital over time, independent of the emotional noise on any given day. When ETF flows go from nearly $1 billion of net buying to the worst month on record inside the same month, That's either a genuine warning sign about institutional conviction, or it's exactly what a healthy shakeout of weak positioning looks like before the next leg. Right now, honestly, it could be either, and anyone telling you with total certainty which one it is selling you confidence they don't actually have. But there's a bigger story underneath the flow numbers, and it's the one actually worth understanding, because it's been building for months and became impossible to ignore in the last several days. For years, if there was one name in the U.S. Senate that Bitcoin holders trusted completely, it was Cynthia Lummis. The Wyoming Republican has personally held Bitcoin since before she was even elected, co-sponsored the Lummis-Gillibrand Responsible Financial Innovation Act, one of the first serious attempts at giving digital assets real legal clarity instead of years of regulation by enforcement, and built her entire political brand around understanding this technology, when almost nobody else in that building did. That reputation wasn't manufactured. It was earned over years of being one of the only senators willing to publicly defend Bitcoin specifically, not just blockchain. In the vague, sanitized way Washington usually prefers. Now she chairs the Senate Banking Subcommittee on Digital Assets and is the lead negotiator pushing for a full Senate floor vote on the Digital Asset Market Clarity Act before the August 2026 recess. On its own, that's just her doing the job she's spent years building toward. Here's the part that's genuinely new. Over the past several days, that exact bill has picked up public endorsements from BlackRock, Fidelity, Goldman Sachs, Charles Schwab, and Franklin Templeton, firms that together manage more than $30 trillion in combined assets. Fidelity, managing around $7.1 trillion on its own, is directly urging senators to bring the bill to a vote. Goldman Sachs' CEO called it a necessary step for market structure, even while admitting it isn't perfect. So the senator who built her reputation as Bitcoin's champion against institutional gatekeeping is now the person carrying the ball for a bill Wall Street's largest asset managers are actively championing alongside her. That's not an accusation. It's simply what's on the public record. And it's not even a clean story of Wall Street uniting behind one position. Reporting also shows JP Morgan has backed changes to the bill that much of the crypto industry, including exchanges like Coinbase, publicly opposes. This isn't one coordinated block. It's multiple institutions with different books of business pulling on different parts of the same legislation at once, with Lummis trying to hold the coalition together long enough to actually get a vote. There's a real substantive critique circulating in Bitcoin circles about this, and it deserves to be taken seriously rather than turned into a slogan either way. A full federal compliance framework, registration, disclosure, legal teams' audit trails, costs real money to maintain. Firms managing $30 trillion can absorb that cost without blinking. A small decentralized project or a person running a node from their living room cannot. Under that reading, a bill marketed as bringing clarity could, as a side effect, raise the cost of participating in this market high enough that it quietly favors exactly the institutions now endorsing it. The other side of that argument, made by Fidelity and BlackRock themselves, is that clear jurisdictional rules between the SEC and CFTC reduce years of regulatory ambiguity that have made it harder for everyone, individuals included, to get a straight answer about what's actually legal. Both readings remain genuinely possible right now. An ethics provision still being negotiated over whether state attorneys general can bring cases tied to it could tilt the outcome meaningfully before any final vote. It's also worth being precise about what this bill would and wouldn't actually change, because regulatory clarity gets thrown around as a vague positive without anyone explaining what it means in practice. The Clarity Act arrives roughly 1 year after the Genius Act, signed into law in July of last year, which created the first federal framework specifically for payment stablecoins. Lummis has described the Genius Act as the foundation and the Clarity Act as the structure meant to sit on top of it, establishing once and for all which federal regulator, the SEC or the CFTC, actually has jurisdiction over which category of digital asset. That jurisdictional turf war between the two agencies has been one of the longest-running sources of uncertainty in this entire industry, arguably stretching back well over a decade, and resolving it is genuinely one of the things this space has been asking Congress for the longest. The current draft also includes more than a dozen anti-money laundering provisions, along with carve-outs addressing how the rules apply to decentralized finance developers and validators, rather than treating every piece of crypto infrastructure as if it were a centralized exchange. None of that is settled yet, which is part of why the bill's final shape and its ultimate effect on smaller participants versus large institutions genuinely isn't fully knowable right now. Lummis herself has said publicly that failing to get this passed risks pushing meaningful legislation off until at least 2030, since a new Congress would have to restart the entire process from zero. whether teaming up with $30 trillion in institutional backing was the price of finally getting this bill moving, or whether it represents a genuine shift in whose interests the legislation actually serves, is a real open question. And it is not the same question as whether Bitcoin itself is a good investment this week. Conflating the two is exactly how a legitimate policy story turns into either baseless panic or baseless reassurance, neither of which helps you make a good decision about your own position. Here's why I'm walking you through all of this in a video about a 3-step plan for people sitting on losses. This story, not the daily liquidation number, is the actual structural backdrop behind why institutional flows have been so unstable this month. Big capital is trying to figure out what the regulatory floor is going to look like before committing more of it. That uncertainty shows up in ETF flows before it shows up anywhere else. It's a more honest explanation for this month's price action than the Middle East scared investors, even though that headline is the one every channel is running with. But knowing all of that still doesn't tell you what to actually do with your own position. That's step 3. And this is the step almost nobody does, because it requires making a decision now while you're calm, instead of later while you're scared. Before we jump into step 3, let me mention something quickly. If you've been watching this and realizing that your biggest challenge isn't understanding Bitcoin, it's controlling your own emotions during weeks like this, then that's exactly why I created the Bitcoin Holder Mindset. It isn't a book about predicting prices. It's a practical framework for becoming the kind of investor who doesn't panic every time Bitcoin drops 20%, doesn't get euphoric every time it rallies, and doesn't let headlines make decisions that should be based on a long-term plan. Because at the end of the day, the market doesn't destroy most investors, their own reactions do. I'll give you a discount code near the end of this video, but for now, let's keep going, because step 3 is where everything we've talked about comes together. Step 3, build your pre-committed decision framework before emotion decides for you. Here's the pattern going back through both major Bitcoin bear markets. In 2018, Bitcoin fell roughly 84% peak to trough. In 2022, it fell roughly 77%. Those were genuinely brutal drawdowns. Nothing happening right now remotely compares to either one in depth, which is worth remembering before anyone calls a bottom just because sentiment feels bad on social media this week. Looking back at who came out the other side of both cycles with their position intact, the pattern wasn't that they predicted the exact bottom or had perfect information about every headline along the way. What they actually had in common was simpler. They decided, before the drawdown started, roughly how much they were holding, why they were holding it, and what would actually have to change about the underlying thesis for them to sell. A senator's new political alliance, a rough week of ETF outflows, or a scary liquidation number was never on that list. The people who got hurt worst in both cycles shared a different pattern. They'd bought with money they secretly needed on a shorter timeline than they admitted to themselves. They held on exchanges instead of in self-custody. And they made decisions in real time based on whatever headline crossed their feed that day. This is exactly why step 3 isn't a trading tip. It's a framework you build once while you're calm, so you never have to make a high-stakes decision while you're scared. Sub-step A. Run the sleep test on your position size. If the current drawdown is genuinely costing you sleep, that's not a signal about Bitcoin. It's a signal that your position is sized for a different risk tolerance than the one you actually have. The fix isn't necessarily to sell, it's to size future positions and think about current ones around the amount you could watch drop by another 50% without it changing your daily life or your decision making. Money you need on a timeline shorter than several years has no business being in an asset this volatile, no matter how strong the long-term thesis is. Substep B, write down right now what would actually break your thesis. Not the price goes down. That's not a thesis break, that's Tuesday. A real thesis-breaking event would look like a fundamental flaw discovered in the protocol itself, a change to Bitcoin's fixed 21 million supply, or a coordinated global ban that meaningfully restricted the ability to transact peer-to-peer. Write your own list. The exercise matters more than the specific answers, because once it's written down while you're calm, it becomes very hard for a scary headline to talk you out of your own plan later. Substep C, get your coins into real self-custody and actually test the recovery process. This is the step almost nobody does, and it's the one that matters most. An ETF is a genuinely useful bridge for exposure inside a retirement account, but it is not the same thing as holding your own keys. If a custodian freezes withdrawals, if a platform gets frozen by a regulator, or if a company managing billions simply changes its terms of service, an ETF holder is exposed to every one of those decisions. A self-custody holder isn't. Concretely, that means moving coins off any exchange onto hardware that generates and stores private keys completely offline, writing your recovery phrase down correctly and storing a second copy somewhere physically separate from the first, so one house fire or flood can't wipe out both. And for anyone holding a meaningful amount, seriously considering a multi-signature setup, where 2 of 3 separate keys, held in 2 separate physical locations, are required before any transaction can move. A standard single key wallet has exactly one point of failure. Whoever holds that key, or whoever can coerce the person holding it, controls the funds outright. A properly configured multi-sig setup means losing one key doesn't mean losing access. And a single stolen device, or a single moment of duress, isn't enough on its own to move funds. And then test it. Don't assume your recovery phrase works. Confirm it can genuinely restore access on a fresh device using only that phrase, no other information required. Most people skip this step entirely and only discover a mistake in a moment when it's far too late to fix it. This is also where that FTX callback from the top of the video actually matters. That $900 million distribution going out this week exists only because roughly $69,000 to $15,500 worth of coins sitting on a centralized platform got frozen when that platform collapsed. And creditors have spent nearly 3 years waiting to get a partial recovery back. Every person receiving one of those distribution payments this week is a real, current example of exactly the risk self-custody is designed to eliminate. It's not a hypothetical. It's happening in the same news cycle as this video. There's one more piece of substep C that most people skip entirely because it's uncomfortable to think about. What happens to your keys if something happens to you? A private key that only one person knows how to access effectively disappears with that person, and there are already well-documented cases of meaningful amounts of Bitcoin becoming permanently unreachable for exactly that reason. A real plan means someone else, a spouse, an estate attorney, a trusted family member, has a clear, secure, legally sound way to access those funds without that plan itself becoming a security risk in the meantime. It's not a fun 10 minutes to spend thinking through. It's one of the highest leverage 10 minutes available to any long-term holder. Put substeps A, B, and C together and you have the actual plan. Know what size you can hold through, know in writing what would change your mind, and know that no third party, no exchange, no custodian, no senator, no regulator can freeze, seize, or lose access to coins that only you control the keys to. Here's the loop I opened earlier, and here's why the information in step 2 changes how you apply step 3. If ETF flows keep destabilizing while the Clarity Act fight plays out, and if the Fed leans toward the roughly 54% market-implied odds of a rate cut at the September 16th meeting instead of staying restrictive, that combination of regulatory clarity plus looser monetary policy is historically the kind of backdrop that eventually pulls institutional capital back in, even after a rough month. It is not a prediction. It's a real, currently unresolved setup worth watching, and it's precisely why substep B, writing your thesis-breaking criteria down now, matters more than trying to time this particular week. None of this is a signal to buy, sell, or hold anything specific right now. It's a process for making that decision deliberately instead of reactively. Before the offer, let me answer the 3 things that flood the comments every single time Bitcoin has a week like this one. Because if I don't address them directly, they'll just sit in the back of your mind and quietly undo everything above. Isn't this just what people say right before it goes to zero? Every asset that has ever gone to zero had a story about why holders should stay calm right up until it didn't. That's a real risk, and dismissing it would be dishonest. But it's also true that Bitcoin has now lived through multiple 70+% drawdowns, 2018, 2022, and smaller ones in between, and come back to new highs every single time, most recently reaching $126,198 last October. That track record doesn't guarantee the next cycle behaves the same way. Nothing can guarantee that. What it does mean is that this drawdown feels scary is not on its own new information. It's what every prior drawdown also felt like in the middle of it. And what about the dollar just losing value anyway? So does any of this even matter? This is actually one of the more underrated parts of the thesis, and it has nothing to do with this week's headlines. Back in mid-2020, plenty of mainstream economists argued that trillions of dollars in stimulus wouldn't meaningfully show up as inflation. In the years since, the dollar has lost a substantial chunk of its purchasing power. Multiple independent estimates put the cumulative loss somewhere in the range of 1/4 to 1/3 since 2020. That's not a prediction about the future. That's already happened. It's a big part of why an asset with a fixed, transparent, unchangeable supply schedule keeps mattering to long-term holders, regardless of which senator is standing next to which bank in any given month, and regardless of whether this particular week closes green or red. Should I just wait for the bottom instead of doing any of this? Waiting for a confirmed bottom sounds smart and almost never works in practice because bottoms are only obvious in hindsight. Nobody rang a bell at $15,500 in November 2022. The people who did well from that level didn't identify the exact bottom. They had already decided, in advance, what they'd do at various price levels. And they executed a plan instead of waiting for certainty that was never going to arrive on schedule. That's the entire point of step 3, and it's why wait and see isn't actually a step, It's a way of avoiding the decision until the decision gets made for you by panic. If you made it this far, you already understand something most people watching Bitcoin content never actually build, a process for staying calm when the market isn't. That's exactly what I built, the Bitcoin holder mindset, to deliver. It's not a trading signal service, and it doesn't try to predict next week's price or the next Senate vote. It walks through the exact frameworks I used in this video and takes them further. Pre-commitment rules for when volatility hits, the sleep test for position sizing, the zoom out rule for keeping short-term price action in perspective, the cycle and motion map for recognizing recurring Bitcoin market psychology, the signal versus noise framework for controlling your information diet during weeks exactly like this one, and the identity-based system for becoming the kind of holder who doesn't have to rebuild their discipline from scratch every time Bitcoin drops. It normally sells for $97. Because you watched to the end, you can grab it for $47 using the code HOLDER50 at checkout. That's a $50 discount. The purchase is backed by a money-back guarantee, so you can go through the material and decide for yourself whether it delivers real value. If you've ever watched Bitcoin fall and asked yourself, do I hold, or is this actually different this time? This book was built to help you answer that question with a process instead of a panic response. The link is below this video. Use code HOLDER50 at checkout for $47 off the regular $97 price while this offer is running. Whatever happens with the Clarity Act, whatever the Fed does in September, and whatever tomorrow's liquidation number ends up being, Bitcoin keeps doing the one thing it was actually built to do, moving value from one person to another anywhere on Earth, without needing anyone's permission. That fact hasn't changed this week, and it isn't going to change because of who's standing next to whom in Washington or which way the ETF flows swing on any given day. The three-step plan doesn't tell you Bitcoin is going up from here. Nobody honestly knows that, and anyone claiming certainty in either direction is overselling their own read on a market that hasn't finished this move yet. What the plan gives you is a way to separate a real thesis break from a scary headline, a way to read institutional flow instead of just reacting to price, and a pre-committed framework so the next red candle doesn't get to make your decisions for you. 2, recap the plan in one breath so you actually walk away with it. Step 1, diagnose whether the protocol changed, whether this is leverage washing out rather than real selling, and whether there's an actual forced selling event underway. Right now, the honest answer to all 3 points toward noise, not a broken thesis. Step 2, stop reacting to the daily candle and check the real signal instead. This month's ETF flows swung from nearly $1 billion of net buying to the worst month on record, against the backdrop of a genuinely uncertain, still unresolved fight in Washington over the Clarity Act, with roughly 54% odds of a Fed rate cut in September layered on top. Step 3, build the pre-committed framework before emotion builds it for you. Size your position around what actually lets you sleep. Write down in advance what would truly change your mind, and move your coins into self-custody with a recovery plan you've actually tested. The exact protection that this week's $900 million FTX distribution is a live reminder of why it matters. That's the plan. Not a prediction, not a signal, a process. What you do with it from here is entirely yours to decide. This is general commentary and education about markets and pending legislation, not financial, legal, or tax advice, and not a recommendation to buy, sell, or hold any specific asset. It is not an accusation of wrongdoing against any named individual. Bill status, institutional endorsements, and market conditions can all change quickly, sometimes within the same week this was published. Anyone acting on anything discussed here should confirm the current status of any legislation directly at Congress, at Gov, verify institutional endorsements through primary reporting, and speak with a qualified, licensed financial advisor before making any investment decisions.